Welcome to Build a Business Worth Buying, the podcast where seasoned entrepreneurs, M&A experts, and world-class operators share behind-the-scenes stories of building, scaling, and selling remarkable businesses. I'm your host, Aaron Alpeter, and every week I sit down with people shaping the world of acquisitions, founders who cashed out, buyers with bold strategies, and advisors who help make deals happen. This is not a podcast for beginners. It's for those who know the grind and want actionable insights to make their next big move. Get ready to take notes, rethink your strategy, and hear untold stories of what it takes to build a business worth buying. Ready, welcome back to Build a Business Worth Buying. Today's guest is Spencer Matthews. Spencer's really interesting. He's an operator turned investor who's got a really unique perspective on what it takes to scale a business worth buying. So Spencer's story started out as one of the founding team members of a nutraceutical brand. I think it was Microbe Formulas, which scaled from 0 to 50 million in annual revenue in just under 5 years before ultimately exiting for under 200 million. In that role, he wore a lot of different hats, most notably as the chief of staff to the ownership and executive teams. And he had a front row seat to what fast growth, scaling an operation, and just the exit process looks like. After the sale, Spencer co-founded Fifth Hammer, which is a family office investment firm focused on early stage brands. So through Fifth Hammer, Spencer and his partners invest and advise companies across the consumer and health sectors, blending hands-on operational support with strategic guidance. So today, Spencer also serves as the fractional COO of Stemregen, which is a stem cell support supplement company where he's helped scale the business from $1 million to $10 million in under 2 years. So Spencer brings this really unique and rare combination of ground floor operating experience, firsthand exit know-how, and now an investor and an operator's lens. So Spencer, welcome to Build a Business Worth Buying.
Thanks, Aaron. Yeah, I'm excited to have this conversation and share what insights and learnings I can.
I want to dive right into the exit. So you helped scale
Okay.
Microbe Formulas from 0 to 50 million ARR and sold it for just under 200 million. What do you think about that
Yeah.
journey actually drove the growth versus, what were some of the biggest risks that you saw along the way?
Yeah, this is one of my favorite questions actually, because it's easy if you go through that experience to like pat yourself on the back, right? You like, but put your chest up a little bit and say, "Hey, I did this, right?" Or "This was me. I was, the reason." And I think it takes a little bit more intentionality to sit back and really look at what really happened. And so I actually spent the better part of a year kind of dissecting what were the core elements that made us successful. And that was kind of parlayed into the founding of Fifth Hammer so that we could then try to identify those in future investments and see if we could actually do this again, right? And so it's fun and sexy to say, 0 to 50 in 4.5 years. But the real journey, and I think this is the reality for most businesses and entrepreneurs, is that the prior 5 years before the company was even launched, the two founders were building a foundation without even realizing it, right? So we had two doctor founders that had very successful 7-figure practices. One had put himself into more of the virtual space, building a social media following and an email audience, right? And so I kind of categorize him as the owner influencer, right? He had an ownership in the business, so was personally, invested, but also he had influence already. He had a sizable 6-figure email list, social media following, right? So that was very significant for the launch of Microbe Formulas, but also for the continuity of it. The other founder, we kind of classify as this founder builder. He had a practice, and he was the other founder was a virtual, his was brick and mortar, and he was formulating products in his own practice, trying to find solutions for his patients that he couldn't find anywhere else. And so he was really influential in the key products and key ingredients early on, right? And so those two alone, I think, are underestimated. And post exit, I spent a little bit of time kind of just studying some of the investors in Silicon Valley and kind of what their models were. And I kept seeing a trend around capital efficiency, right? And these two elements brought us a lot of capital efficiency. In the software world, if you have a founder that's a developer, well, then you don't have to go pay a big development team, or you don't have to pay it as much, right? In the nutraceutical world where we pay, same thing. If you have a founder that's a formulator, then you don't have to go pay a formulator or a scientist, right? Like then they understand the science in a way that they can explain it. So that improves capital on the product development side, go to market side. But then if you have a founder that already has an audience, that reduces your CAC, right? Because you can already have a built-in audience. That reduces your need for marketing spend. So it really provided us a capital efficient way to launch. And so those were two key elements. The fact that it was a niche product. We started in parasite cleansing, kind of went out into a detox space, so it was pretty niche. But that ability to broaden into other areas, um, those were key things. Um, we did our own events quite a bit, so it was at its season, and this was part of just the good timing. I mean, you hear timing and luck. I think it is a part of every journey. You can't plan it all, but we were we were doing virtual summits when virtual summits were pretty popular, and so we would get 30 to 80,000 registrants into one of these, and we did nine of them.
Wow.
Right.
Yeah, talk about
And
capital
then we
efficiency. That's pretty good.
Yeah, yeah. So, I mean, those are some of the core things. And then we were multi-channel. So we had a D2C side that was very profitable and high margin, but we had a wholesale brand that actually was a separate brand, but under the same entity that allowed us to get into practitioners and and that built slower. But then we did in-person events for that audience where they could earn CEUs, and we really created a really strong community. And that kind of gave us some long tail growth, and eventually actually overtook the D2C. But those are some of the key elements that we look for in investments today, but that we also like recognize were key levers in the investment in the past. And I think the biggest risk in our experience was through that hyper growth is cash. I think any business, right? Even if you're hyper profitable, if you're growing hundreds of percents year over year and month over month, it's cash. We were even though we were, 20 to 30% EBITDA, we were maxing out credit cards. We had 500K up, in credit line. Like we were, it was a lot. So that's always a big risk, is managing cash. And then regulatory, especially in the, nutraceutical space, making sure that you're staying compliant and the regulatory landscape, and you don't, so
Yeah, no,
that's
I
a few
love the
highlights.
two things that you did. Yeah, I love two things that you did there, where you you took the time to not only go through that experience, but you also stepped back and did this research. I think the way that you framed that capital efficiency as being the key thing, that makes a ton of sense to me. And I've never quite heard someone connect the fact that someone already has a following as being capital efficient in the acquisition, or someone already having these hard skills to develop something being capital efficient. But you're exactly right, and I think that's where most people should look at this.
Yeah, I we've tried to extract as much learning as we can from the experiences we have, because we feel lucky to be part of them, and yeah, hopefully can apply them to more brands, but more opportunities.
Yeah, the chief of staff role that you held is an interesting one. And I think that you're kind of in the C suite, but you're not making most of those decisions. You're able to kind of really be there. And I'm curious, when you were getting ready for that sale, what were some of the things that were either the biggest surprises or the hardest lessons that you or your team encountered?
Yeah, it was a really fun spot. I mean, apart from very few interactions, I basically had an ownership seat without having ownership, if you will. I was in all of the board meetings, all of the executive conversations, and one-on-ones with our CEO, and we had a CEO change during that. And so it was a really fun window, and I got to act as a sounding board and advisor. But I think going in, we changed on a kind of a, a, a split second of like, hey, we were really building something for legacy. Our founders, our owners, did not have the intention of selling this business, but then they saw some of the kind of the indicators in the market and had heard of similar brands exiting, and they were like, whoa, well, maybe we could do this. And so we engaged an investment banker, and like overnight, honestly, within a matter of weeks, we were like, okay, let's package this thing up. But I didn't realize, like, it was a full-time job for me. So basically my job shifted to like, okay, invest or exit prep,
Yeah.
right? For 9 months. That was
Oh
my job.
gosh.
Alongside, pulling in our CFO and then our CEO and other team members, because it's definitely takes more than a team. And we were lucky to have an awesome investment banker who had a team. So that was, I didn't understand or appreciate the work that goes into that, but the amount of documentation requested and required, and the different kind of phases right, of that whole process. I mean, the packaging a business for sale, you know. So that was eye-opening for me and a big surprise. I think as we got into actual conversations with potential buyers, um, and deeper due diligence with them, I was shocked at how little they really cared about the marketing and the brand,
Really?
and how much time they spent on um, regulatory security, like cybersecurity, um, like product ingredient science and stuff there. Yeah, and it could have been that our numbers checked. We had a great CAC to LTV ratio. We had a great CAC to AOV ratio. So we had those boxes checked. And so it's not that they didn't look at those at all, but like most of our conversations, most of our in-depth reviews were all on the different parts of that. We maybe had like one marketing call to like 10 finance calls, right? Or four regulatory calls, or two, three technology cybersecurity calls. So that was eye-opening for me. And our VP of marketing at the time, he was kind of like, oh, well, I guess they don't need me. But yeah, and then because we were structured as an LLC, no funding, no investors, um, no debt, we didn't have a formal board. But it was interesting to see like how many times that we were asked like, well, where are your board minutes? Where are your board notes? Where is this type of stuff, right? And that's probably pretty typical if a company that's going to exit, or especially if a company that already has an investor or investors or board. And we had meeting notes, right? Of like, hey, we documented what happened and what decisions were made and action items out of our meetings, but we didn't have like the traditional minutes and stuff. And um, so that was interesting. And yeah, I think just hardest lessons through that was document,
Yeah.
or have organized documentation as best you can.
It's interesting because you said that they didn't dig into the things that you expected them to dig into. Is that because they didn't care, or like you said, is your sense that they're like, oh, it's fine, let's go dig on the other stuff? Like, I guess what I'm trying to get at is when they were digging into regulatory, they're digging into the formulation. Is that because that's where they perceived the most risk, or because that's where you were maybe least prepared to show stuff?
Yeah, I didn't fully understand it at the time, but if I like put my investor hat now, like I think you nailed it on the head. I think they saw, hey, the numbers are penciling. They're spitting out cash, right, at a 25 to 30% rate. The marketing metrics are there. They did a little bit of like cohort analysis. Like, so it's not like they didn't put any time. It was just the amount of time they put towards the other stuff. So we were mostly talking to institutional buyers, right? Private equity firms. We had one strategic, um, but most of the PE firms, they were more about, okay, how do we minimize the risk? How do we make sure that this is locked in? I think that they felt comfortable, like, okay, we can make this work. We can scale this from a marketing side. We have those bases covered. Let's just make sure there's no risks that are going to prevent us from doing that. And I didn't have that lens during that
Mm.
process, right? And they didn't necessarily come out and say that to us, right? But definitely looking back, it's like, okay, they just wanted to make sure there was nothing, really handicapping the
Yeah,
growth.
they kind of already decided that they wanted to buy the company, so they're looking for an excuse not to buy it at that point.
Yeah, yeah, no, that's a good. I like that explanation.
Yeah. If you had to go back and talk to your early stage operator self, what advice would you share?
Oh, it's hard because I really feel like we approached it well. The lesson learned of like, hey, have good documentation and have, good financial books. I would say the biggest lesson learned is have your eyes on the finances and have good financial reporting as early as possible, above everything. We kind of had to throw out the first year and a half, 2 years of our financials because they were just so messy. We didn't have a really strong financial team in the first 2 years of the business. So we ended up pretty much using 2020 and 2021, right, as our financial reports. So I would say that like it's really easy to get caught up in like, oh, we need really solid documentation. And while that's important to exit, it's also work that can be done when you're preparing to exit. What I don't want founders to do or investors to get hung up on is that they spend more time in documentation than they do in like generating sales for the business, right?
Yeah.
Like having all the SOPs created and having all this stuff buttoned up and dialed in. And I think we did that well as we focused on what made money profitably first, and then we cleaned up the regulatory and we cleaned up the documentation along the way. But the one thing that we should have done all along is just really solid financial reporting. So that would be the lesson
Yeah,
for sure.
it's hard to go back and remember why a certain transaction is categorized a certain way 18 months later. So that makes
Yes. Yes. Yeah.
So let's kind of transition. So you've got this great base of having a front row seat to a company that is kind of building as if they're going to be around for a long time. They then decide to exit, and then you said you've got 9 months of learning how to exit a company. Now you're on the other side. Now you're investors. So let's talk a little about Fifth Hammer. And you are today investing in very early stage brands. And so when you look at a company, what are the top signals that tell you that this is worth your time or investment or reputation?
Yeah, we look for some of those key levers again. So the owner influencer, do they have an audience already, or are they a personality that they could build an audience around? They're good on camera, right? Or they, good on a podcast or something like that, where and the category has enough time horizon to build an audience around them, or they're, a founder builder. So we like to have at least one of those. We had both in the prior one, so both is great, but at least one of those. They show early signs of product market fit, meaning they're not pre-revenue, like they have revenue, they with good testimonials, right? They have product that's getting good results for people. Like we care about that because we're not we're more in the game of like a million to, you know, 7 figures to 8 figures and exit. Right. That's where we want to play. We're not the 0 to 6 figures and try to figure out if this is going to work. So that's an important one for us. And then science, in a niche. That was important for us. We started, with 2 or 3 products in Microbe Formulas, and then we expanded to a product line of 20. Um, but like it started very niche and we slowly kind of added on, and we always really still stayed pretty niche. And so a specialty niche that has a big enough audience, right, to get to those numbers, 7, 8 figures, but also then could expand into a larger category down the road so that there's opportunity for a buyer. Um, so we look at that, and then probably one of the biggest one is just the founder. What's their track record? How like what's their integrity level? Why are they doing this? Um, what do they want to do post this?
Mm.
Right? Is their ultimate outcome actually to exit or not? So I think the founder is often it is heavily emphasized, but I think maybe for looking at the wrong things or not necessarily the right things. So we just try to align expectations of why we are interested in what the founder really wants to
So
do.
say more about
Um,
that, because I think you touched on two things that were interesting. The one was, does the founder want to exit? So as an investor, I can understand the importance of wanting to get your investment back. If you're funding someone's lifestyle,
yeah.
that's probably not great. The other piece that you're bringing up is just, you know, why do they want to do this and what do they want to do after it? So talk to me about kind of how do you suss that out and what makes it interesting to you?
Yeah. We've worked with several different founders, some that like this is their life's work, right? Like they've spent 20 years in this industry, in this specific industry, that their product is in, and they're just experts in it, right? Others that like they kind of have bought the business or taken it over or, newer to it, but they also see an opportunity. And so, um, for us, it's more about how, um, how are we going to work together and are we aligned with where we want this business to go, and and not just in it for the money. Like the reason why we've stayed in the consumer health kind of nutraceutical space is because there is a very easy play for mission-driven, cause-driven alignment. For us as an investor, for future investors, for team members, right? For customers, right? You're instilling hope and health into the customer. Um, and so that matters to us. And it also differentiates a little bit. There's plenty of supplements out there that are just pump and dump in it, for quick money, ride a fad. And that's not the game we want to play. We don't feel like that has real lasting impact in the world or in individuals' lives. And so um, it's just really kind of seeing what's that heart of the founder. Are they aligned with kind of some of our ethos and what we feel like actually adds value in the world versus just a cash grab?
Yeah. And so as you're evaluating the founder and the business itself, what are some of those red flags that would encourage you to walk away from a deal?
Yeah, we always we'll bring them out to our offices and host them and just interact with them. And then a lot of times we'll go to an event where they are. Like if their business is already an event, we'll see how they show up, we'll see how they interact. And sometimes it'll be a few interactions. And it's just how are they spending their money when they're with other people, in their industry and their peers? How are they interacting with their peers in the industry? Are they super ego proud, are they lavish and kind of, their spending in some of those environments? Are they courteous and generous in others? So it's just kind of more just observing, I think maybe some of the behavioral and character traits, in different settings. Because it's easy to talk, it's easy to say the right things, it's easy to get on a Zoom and have a chat. But so we try to assess it over time. A lot of times, how we'll enter working with a brand, even before we invest, is do an audit, or even do like a 90-day consult, just engagement, and see. And we really like kind of that testing model, whether it's us for an investment or us for, a client, or them for us, right? Or even a new team member that we're hiring to try to put in a brand or put in one of our own companies. Um, Truth experienced is more impactful than truth told. And we feel like we've learned a lot of truths and we can tell them to people. But if we can learn truth by experiencing things together, I think we speed up that learning. So
That's helpful. As we were kind of talking before the podcast, you mentioned that you guys not only do direct investments, but you also take operating roles in some of these companies. And you made the comment that
yeah.
you can't really operate too many brands at once. And so I'm curious how you go about that, where, what's the difference between, hey, this is good enough for my money versus this is good enough for my
Right.
time?
I like how you break that up. Um, hmm. I probably haven't thought as much about this one, but I would say cash flow constraints. It depends on the business, right, and the brand. We have some investments that are, we see more as a long-term play, but it maybe aren't producing as much cash as we want right now. So they're, a 3-7 year play versus kind of like an immediate opportunity. I would say the size probably of the category. Um, we're in kind of the longevity space with one brand. We're in the women's health space with another. We're in like the practitioner kind of general health space with another. And so it's what's the size of that opportunity and the time horizon for that category? Longevity um, is on the rise, but some markets of that have kind of already popped.
Hmm.
Women's health is really popping right now and might have, so I would say, and then the team, what existing team already do they have, right? Do they have a team that's kind of already taking care of what we would come in and do? And if so, can we just guide the existing team or install a few pieces around them? Um, so it's probably that, cash flow, existing team, and then opportunity and
Yeah.
category.
Do you find that
Uh,
you tend to spend your time on the neediest businesses? And so it's more of a, hey, these guys are cash flow constrained or they don't have the right team. And so I'm gonna put my efforts there to kind of uh, save a difficult situation. Or do you try to put your time in where you think it's going to have the highest ROI? So maybe it's It's the one that has the best cash flow, and you're like, hey, I know that if I work on this, I can 5x it or 10x it faster, and so that's where you're putting your efforts.
Yeah. I haven't analyzed it that way, but I love that. I need to spend more time on that. I would say if I'm looking at how my time is split now, it is heavier on the ROI side, right? And we've put actually more, no, probably an equal amount of money, but more money, more advice on the other one. That's like, hey, let's find the right partners. Let's give you some time to kind of correct ship a little bit before we put more of our, time into it. So I would say, yeah, more of my time today is spent on where's the biggest opportunity versus like the needy child. But that's hard, right? Because and it's also like, um, it's the challenge of firefighting, where it's like what fire can wait or which one actually isn't a fire, and helping the founder realize that. So there's definitely some learnings that we're going through now on like boundaries, time split and all that.
Yeah.
So
Okay. So I think one of the things that's just interesting about you is you have seen all of these different angles from, someone that's sold a company, someone that's investing in a company, someone that's running a company now. And I really want to focus in on what is your thesis around what actually matters. And so, when
mhm.
you think about the things that founders overestimate or underestimate, what is it that really matters when it comes to trying to build something that's valuable?
Yeah, at least in the, e-com space, there's a lot of fanfare around subscriptions. Everyone wants to try to create their e-com business as sexy as a SaaS business and try to spit out the recurring revenue, and investors love that too, right? Financial like FP&A geeks love that. And so I think, the likes of Dollar Shave Club and brands like that have honestly kind of hurt the category from a sense that like there's overemphasis and I think subscriptions are overestimated because at the end of the day, if your product works and it gets people results, they will come back and buy. And we've seen that time again, at least not that you shouldn't market, you shouldn't have a subscription offer, you shouldn't do some of that. But I think that also that dovetails into the retention side, right? There's a lot of emphasis on retention and subscriptions. And we've seen brands geek out over loyalty programs and invest six figures into setting up these complex things. Um, and we see investors and financial people like look at the cost of paid media and they're like, holy cow, like this is the first expense we should cut because it's so expensive, right? Um, and I would say those are all things not to do and all things that are like overemphasized.
And so would you suggest that they put those efforts not in loyalty or retention, but more into product itself?
Yeah, product quality for like because that's the ultimate customer experience. Yes, like have a nice package, have good delivery times, but like the ultimate customer experience in a nutraceutical supplement brand is that you actually get the results that people want,
Yeah.
right? And need. And then stay focused on acquisition. Don't ever don't ever. I mean, even nine-figure brands, like never stop focusing on customer acquisition. And for most brands that are starting out, again, unless they have an owner influencer, they're really good at organic, like they require that's paid media, right? And so I think underestimating the critical nature of always having an acquisition strategy that pencils, right? A low CAC, high AOV, high LTV, like that matters. Those things matter. And I don't think you could ever overestimate that, unless you are selling a really crappy product and and then you don't have any loyalty. And so that's kind of always my fear is like, or that's actually a red flag for us, especially in the supplement space, is if you're super subscription heavy and retention heavy, is it because you don't have a good product,
Mm.
right? Or is it because you're trying to compensate for the lack of quality? So Now, that's not true for all e-com brands, right? That's obviously not true for SaaS, but in kind of our niche, those are some just nuances. Um, and then team, I think, uh, especially in today's era of AI and automation, like having a lean team, it's different when you're building a team, preparing a business to exit versus building a team for a business that you're going to run forever, you know? And it's really easy to get bloated when you're um, not planning to exit. And anyways, now I'm rambling,
Yeah.
but
You're touching on a big thing there. Is like, and I've noticed too in businesses that I've advised and in my own businesses, is it is really easy to kind of um, spend money when it's not yours, right? Or not being as
yes.
diligent
Oh,
as you should
amen.
be. And so I guess what's the right level there? Does it make sense for every business, regardless of if it's a lifestyle business or it's a venture business, to be counting every penny and to be trying to save 37 cents on a paper cup, or is it something that there's a balance? Like, how do you look at that and evaluate if someone's being a good steward of the investments that you're making?
I love how you phrase that and how you spend other people's money. And we're actually learning that now over the last 2 years because in the previous business and exit, it was all our own money. We didn't have investors, right? And so now we're investing in brands and then operating with other investors in those brands as well. And so it's definitely um, it's definitely different. I think it's easier to get both sides. It's easier to spend when it's your own cash, but it's also easy. It's easier to have a false sense of security when it's other people's money, especially when you do a round of investment, because then you're like, oh, we got all this cash. We're good. Let's go. You know? And again, I think it goes back to like having really strong financial reporting, really clean and accurate financial reporting. There's a lot of benchmarks, right? And kind of ideal metrics that you could track to. But at the end of the day, if you have good gross margin, especially in ecom, like 60% plus with um, good net, EBITDA margin at 20% plus. Like if all you did was look at those two things and you ruddered in those ratios, you'd be okay. But I think most people aren't looking at those things. And if they are, they may not be accurate. And then when you raise a round of a million or a few, you're like, oh, we got so much cash reserve, we're going to be good. So I would say just having some core kind of North Stars for the cash side so you're not like, yeah, to your point, trying to save every penny and stepping over, you know, dollars to get dimes, but you're also not blowing through cash and then having to go raise another round,
Right,
you
right. Yeah,
know?
once you're on that treadmill, it's hard to break that habit, and you end up maybe exiting, but not owning very much of that exit. When you are talking to brands today, there's always this tension between profitability and growth, and investors always want to see both. And so, how do you tell people
Yeah.
to advise it? And if I'm looking to prepare my business to sell in the next 18 to 36 months, how much should I be focusing on profit versus growth?
Well, I think you just said the most critical piece to that, which is what's the expectation of time, right? If it's 18 to 36 months, that's different if you're saying, hey, 4 to 7 years, right? And so if you're wanting to sell within 18 months, you got to be all focused on profit, especially if you're below 20%. Then it's like you got to do everything you can to juice profitability. If your investor or you are more patient or you feel like the category can bear a longer timeline, then yeah, push growth um, more and then pull into profits later on. I think I don't love brands that only push growth because then you don't have a real indicator of the potential for profitability unless they have really good gross margin, contribution margin, unit economics, and most of their bloat is in OpEx, and there's clear ways to cut that. But um, our investment banker and a few others that we've talked to are always like, hey, to maximize your valuation, you want at least 18 months to 24 months of optimal profit. And so that's kind of how what we advise brands. And that's kind of been the unlock for us is that sometimes it's hard to get founders on board with that or other investors on board with that come from different backgrounds or different life experience, right? That are like revenue first, sales first. And so the only like, and again, we can say it, but for some reason our voice isn't always as strong as others. And so what we found work well is just get them on the phone with the investment banker, like schedule it, like, okay, don't take our word for it. Like here's what they're telling you they need to go sell this business. Um, so it's definitely a blend.
Yeah, and I think it's interesting because kind of the tension that I can understand is it sounds like, you know, there's a certain revenue plateau where you're going to say, hey, we're ready to sell this because everybody has an exit multiple
Yeah,
or a number that, if someone said, hey, I'll give you $5 million to walk away from your business day, some people say absolutely. Other people say no, like add a couple zeros and then maybe
right.
we'll. And so I think part of this is understanding, what is that exit window that you're looking
Hmm.
for. And so I guess how do you think about that with whether it be the companies that you've invested in or that you're operating? Because there's an element here where it says, all right, if I know that, we'll take Microbe Formulas, even though it wasn't planned, you got to $50 million in revenue.
Right.
That's a very clear exit window. And so, if
Yeah.
that was the plan for, say, Regen, right, the Stemregen, the company you're at
Yeah.
right now,
Yeah.
like, is there a thought here where you're going to say, okay, over the next 4 to 5 years, we need to grow this to $50 million in revenue, or maybe it's $45 million in revenue. We need to do that in the next
Right.
3 years, and then we are going to throttle back on growth and make it as profitable as possible because we know that our buyer is going to be looking to buy something at a multiple of $50 million in revenue. It doesn't make sense for us to grow to $75 million in revenue and not be profitable because we want to have both the
Right.
revenue multiple as well as the profit multiple. Like, am I thinking through that the right way, or what would you add?
Absolutely. Yeah, no, absolutely. And it really depends on probably the investment banker you're working with or talking to, like, and talking to them early, I think helps. Well, I've been surprised at how many investment bankers like are willing to play the long game, and they kind of advise brands earlier on. Not all, but the right ones, because they see, hey, this could be a deal in 3 years or 5 years, you know. But yeah, you're thinking about exactly kind of how we would like, hey, here's for this mid-market um, asset, right? Your buyers are going to be buying at prices of 100 to 250, and they're going to be doing it on revenue multiples of X, right? Or EBITDA multiples of X. And so we need to be in that 30 to 50 million revenue range with that 20 to 30 plus profit range to get right even close to the. So yeah, it's exactly kind of how we look at it. And then, it's maybe not as bad as like predicting the stock market, but it's also like we don't know. We can't, no one can really,
Yeah.
predict the market, but we try to look at, okay, hey, the longevity space is kind of growing at this CAGR. It's, what's the interest? What's the Google trends around it? What's the, geopolitical environment over the next, we just have, 4 years with the new presidency and stuff, and try to target like a window of 12 to 24 months where we say, hey, we hope to be ready to exit by here, but whatever time range that allows us the best valuation.
Yeah.
So, and we got lucky too with Microbe on that. Like we were really fortunate through COVID to keep our doors open, and there was a great like push to natural health. And then we exited in April of 2022, right before a lot of valuations in the space just tanked. And so you can't predict that. You can't,
You look
you
really
know,
smart if you do, though. I mean,
you do. You're right.
um, you are actively engaged on this journey with STEM Regen. And so you've grown from
Yeah.
1 million to $10 million in just a couple of years. And so what are those principles that you've instilled into the company that help you scale up that could be applicable to other early stage brands?
Yeah, there's kind of a set of, I mean, at the end of the day, there's a lot of um, operational frameworks out there, EOS and traction and scaling up, and Vern Harnish's group, and Alex Sharfin has one. I mean, and people kind of create their own. And I think that there's a lot of good elements from an operational standpoint that we've taken from those types of models and just kind of created our own frameworks around them. Um, a few of which is like company scorecard, right? What's the ultimate outcome for this business and the key KPIs that are going to get us there, and then trying to stay focused on the, strategic initiatives that are going to produce those outcomes. It's not unsimilar from like OKRs or a lot of those type of things, right? And just a healthy company cadence as you scale, right? The team size gets bigger, and so making sure you have the right comms, right communication, right? We like to do like a monthly all hands with the entire team, and we have a really kind of transparent approach. And then we do a weekly stand up with the entire team, and then one-on-ones, with direct reports and things like that. So just opening those. A lot of startups don't understand those things. A lot of founders aren't necessarily coming, from middle management and other businesses and understand some of those importance. But being able to, share information openly and across the organizations helps everyone else understand their role in the bigger picture. Um,
What
and
are your
some,
favorite
yeah,
frameworks that used to say if people need to start with one, you'd say, look at this one.
I think EOS is probably the simplest. There's nuances there that I don't love, like, and that we've tried and implemented, but I think it's basic and simple, and it's probably got one of the widest like support groups for it. So it's not like super expensive to figure it out. You could literally just get the book and do what's in the book.
Yeah.
So um, I would probably point most people there if they're not familiar with it, or don't have someone to like help, coach or guide through something.
Cool.
But that's kind of the operational side, right? There's, I think where brands over index sometimes is there if they don't have good marketing. Because at the end of the day, if you don't have marketing and sales, like you don't have anything to operate.
Yeah.
So, um, leaning into what's worked, from a scale standpoint, we were doing a lot of just organic growth through social media, through in-person events, and that was working to some degree. But we found a really strong partner, and that had a really active, engaged audience, and we sponsored their event and partnered with them on educational content, and that's been a big driver of the early growth. And then before we had this was part of it before we had like the cash flow and the budget to bring our CMO partner in, right? I was involved, and then he came in and is now installing a lot of the paid piece. So um, yeah, you gotta have at least one channel in the marketing side that you can really um, have growth into, and then yeah, just some core operational frameworks to support it.
Yeah, that's helpful. Um, when you're thinking about the category that you're playing in versus executing in that category, have you seen any examples of great execution overcoming a mediocre market? Or is it something where,
Hmm.
you can be a poor executor, but if you're in the right market, you're doing well?
Yeah, I don't know that I have like a brand or a product specific, but I think Amazon brands or Amazon products are good examples of like just execution quality.
Hmm.
There's plenty of like trendy or fad products, on Amazon that aren't necessarily like, or maybe in a mediocre market, but just execute really well and rise to the ranks. And maybe not even like great products, but they just take over,
Yeah.
But I would say like that those are short lived. I still am much a believer of like Mark Andreessen's philosophy that market always wins. Um, you know, team, whether it's team, product or market always wins. The nuance there for us is that it all hinges on expectations, right? Is your expectation that and you talked about this earlier, that I'm going to sell for 5 million, you know, um, well, then you could probably be in a mediocre market with a really quality team and execution and accomplish that. But if your expectation is, hey, we need to pay for 4 6-figure salaries, and we've got to have this, multi 9-figure exit. I don't see mediocre markets like being overcome at that level by just really good teams.
Mm. Yeah.
Like that's, and I don't necessarily have all the data points. I'm sure there's examples, but that's kind of just
Well,
where
it's
where,
interesting
where
because
I
I
would probably
think
stand.
that going back to the conversation we were having earlier, if you're clear on what exit window you're aiming for, right? Then you build for that window. And if you're
Right.
trying to sell for $1 billion, first off, good luck. But you build that business
Yeah.
very differently. You've got to do that in a tighter window in order to. So you're going to attract different types of people. They're going to commit to working on something for a limited period of time. And so I think that what you're saying is making sense, where it is important for you just to be realistic with yourself and your team about what you want to sell for. And there are lots of deals that happen under $1 million, right? You shouldn't
Yeah.
have four
Yeah.
6-figure salaries there in order to sustain that, because that's not really what's going to be there. So I think you're right. Like, the expectations for what you want, your investors want, your employees, I think if those are aligned, then those kind of move forward and make it interesting.
Yeah. But I don't know that there's a right answer, right? What I've gravitated towards with Mark Andreessen's kind of philosophy is, if you can get as many of the dominoes to align, the better, right? Like if you can be in a great market with a great team, with a great product, like that's when magic really happens, right? That's when you can get unicorns, but that's the rarity, right? So if you're going to pick one, try to pick a market. I think that's the hardest to pick. So it's like, you know, it's easy to say team because we're all human, and human capital and human resource is one of the most important lifebloods of a business. Um, and we're part of that equation, right? So it's hard to like knock that or feel like you're in integrity if you're saying that doesn't matter. But I love this. I love this question.
Yeah. Well, to
Yeah.
some extent, what was it? It was overstock.com. Maybe it's wrong, but there was somebody that had put AI in their name. I think it was Wayfair, actually.
Oh,
They
okay.
had
Nice.
they rebranded or put something where it was like the legal name was Wayfair.ai or something. And as a result, their stock market, went up by
No way.
just because the algorithms were picking this up. I'm probably mixing up the name of the company, but this did happen.
Sure.
And so to
Yeah.
some
Good
extent, there's
example.
a
Yeah.
piece here where you're right, picking the market is an important thing. And there's an element here where you want to pick the right market, but you don't want to chase a trend just for trend's sake. And so I always joked around that, a couple of years ago, if you were a Bitcoin AI subscription business, you could raise
Right.
any amount of money you wanted, and people go, yeah, sure, of course.
Yeah. How much? Yeah. Yeah. Totally. Yeah. It's hard to pull AI into supplements. So we haven't been able to crack that. Haven't been able to crack that trend yet.
Yeah, yeah, there you go. Well, Spencer, we're coming up on time here. We've got two questions that we always ask our guests on Build a Business Worth Buying. The first one is, what's the best example of a moat that you've seen a business build?
The first thing that comes to mind is community. I think it's also, you talk about something that's underestimated in a business, having raving fans that love your brand, your products. And that's why I think the owner influencer model supports that, because then they can fall in love with the person. Now, there's nuances, right? With when you exit, like that person as the face of a brand. But I think community is a big moat that can overcome a lot of things that's um, kind of had different times and seasons of focus for people. But
That's great. And if you had to start from scratch today, only knowing what you know now, what would you do to go about building a business worth buying?
I'd find a partner. I, you know, yeah, honestly, find the right individual that could be, or a small group of people that could be bring as many of those elements together as possible. I think another, I'm in Boise, Idaho, and one of the big kind of local successes for out of here that's a niche in kind of the direct response online marketing world is a brand called ClickFunnels, um, and Russell Brunson. And I was lucky to kind of be a little bit on the inside watching that story. And I think part of that was community for them, but part of that was also Russell was the ideal avatar, meaning that, finding someone that understands deeply and intuitively the challenges and the problems that the audience is facing, then you would just naturally build that into the product and into your communication, and it just flows more naturally and it's not forced, right? And so I think, finding a partner that could be that owner, influencer, founder, builder, but also understands it intimately the main client avatar, is what I'd go look for.
That's great. Well, Spencer, this is great. If people want to connect with you, talk more about this, learn more about Fifth Hammer, what's the right way for them to do that?
Yeah, Spencer Matthews on LinkedIn, spencer@fifthhammer.com. Reach out. Happy to have a conversation and happy to dive deeper into any of these questions. I love exploring this space and learning from others in the industry as well.
All right. Well, thank you. And thank you all for listening. And we'll do this again next time.
Thanks, Aaron. Cheers.
Thanks for joining me on Build a Business Worth Buying, brought to you by ISBA Consulting. I hope today's conversation gave you real insights into scaling smarter, selling better, and thinking like a strategic operator. If you found value in this episode, make sure to subscribe, leave a review, and share it with someone who's building their own sellable business. Until next time, remember, the real win isn't just building a business, it's building one worth buying.